It is my pleasure to welcome you to another virtual NBIM Talk. The topic today is real estate. This year marks 10 years since the fund got its mandate to invest in unlisted real estate. During these 10 years, the fund has built a significant portfolio of investments and become a major investor in global real estate. Today, we are releasing a publication which sums up the past decade of real estate investing and provides a comprehensive overview of all our investments. This publication is available on our website, and we will also give out hard copies on request. In today's talk, our CEO Yngve Slyngstad and our CIO Real Estate, Karsten Kallevik, will take a look back and reflect on the journey we have had. We will also call two external guests in London who have followed us closely during this decade. Mark Burton, a long-term external advisor, and Paul Clark from the Crown Estate, one of our long-term investment partners. During this session, you are welcome to ask questions. Please type your name and the organization you represent and send this to the number listed on the screen. Depending on time, a selection of these will be asked at the end of the meeting. With that said, I hope you will enjoy the talk, and I give the word to Yngve Slyngstad and Karsten Kallevik.
The fund was given a mandate to invest in real estate in April 2010. The idea was quite simply that real estate would be the third asset class to the fund after fixed income and equities, and that it would diversify the fund, increase returns, and reduce risk. It was in addition considered an ideal asset class for a fund like ours. This is a very large fund, very long horizon, no fixed liabilities, and with a target to grow in line with the world economy. And the cash flow from real estate would suit that description quite neatly. However, it was many years of discussions before we actually entered the market. And the thoughts that were discussed at the time was quite simply that it would be an enormous task to build up a real estate team to that scale to execute a strategy for a fund like ours. And in the summer of 2010, we were only a handful of people, and I discussed at the time with Karsten Kallevik, which I got with me today, about whether he would like to join the fund and start to build up our investment efforts in real estate. So Karsten, why on earth did you join us?
Well, as you said, it was a very unique opportunity. This was a chance to be part of something very special. The challenge of building an investment organization and influencing the investment philosophy of this endeavor in this context, on this scale, within the confines of a central bank was just a very exciting opportunity.
So we chose from the start to build a quite concentrated portfolio, focusing on 8 cities and really 3 sectors, logistics being a good part of that. And I think the strategy has been quite stable and changed very little since the start.
Yes, because of this scale, there were 2 major considerations that we had to incorporate. One was that the idea of having a portfolio we had to change a lot was not very appealing. We didn't think that we could practically or efficiently trade assets on this scale for a long period of time. And so we wanted to pick long-term markets where we could be invested through cycles. And then secondly, once you pick these long-term markets, we had to balance the scale with the focus. So we wanted to have be in few enough markets that we could really invest from a point of knowledge and specialization. So when we picked these long-term markets in these fairly few sectors, and we knew there would be cycles, well then that created a framework where our strategy could be fairly stable, even though of course, we have to adjust along the way.
So our first real estate transaction, I think the one that many people still remembers, was buying 25% of Regent Street. And we bought there's more than 100 buildings in that street, and the purchase price was actually less than the cash flow we got into the fund for that single week. Which of course illustrated for us the enormous challenge this would be if you really should scale this up to that extent. But it also showed another thing, that we were looking for great partners, but also that we have all the time from this first investment to our latest in Otemachi in Tokyo targeted high quality buildings that we intend to own for the long term, really.
Yes, and that's part of this long-term strategy and the ability to invest through cycles and actually survive down cycles as well. And I think the quality of our assets in these core markets have certainly played a key role in the stability we've seen in building up this.
So, any transactions you would like to highlight in addition to Regent Street?
As I said, Regent Street was the first one, so you never forget that one. A couple of years later, the largest transaction we ever did was in early 2015, where we acquired a large portfolio together with of logistics assets together with our partner Prologis, which we had been invested with for several years. This was an enormous effort, 322 assets in 17 states in the US, and it was pretty much done over 2-3 months, and we ended up funding 21 billion kroner for that single deal. Another transaction, which was the fastest we've ever done, was in the summer of 2016, in the aftermath of the Brexit vote in the UK, where we found, analyzed, performed due diligence, signed the documents, and funded the purchase of one of our assets on Oxford Street in less than a week, so in less than 7 days from beginning till end. And that was just an extraordinary effort from the whole team, both in Oslo and London and elsewhere, that all chipped in to help out. And of course the last one, where earlier this year, when we acquired a stake in a very high quality asset in partnership with one of the preeminent and absolutely most respected investors in Japan, Mitsubishi Estate. Of course, there are many other buildings as well, and it's been a long journey. But
so during the last decade, we have invested a total of 168 billion Norwegian kroner into the real estate market. And we look at the value of the portfolio today, it's crossed 270 billion, so a value increase of more than 100 billion. And it generates a return for us annually of more than 10 billion Norwegian kroner. Any chance we're going to have another decade like that?
I doubt it. We didn't expect that level of return 10 years ago, and I don't think we should expect it for the next 10 years. And of course, not all investments perform equally well. I do think that the consistency in returns across our portfolio has been surprising, and it gives me at least some comfort in that we are well positioned going forward.
So how about the 3% real return or the 5% nominal that the fund has a target? Can you promise that for the next 10 years?
I think we can do it. I'm fairly confident that with the quality of assets and the locations we have, that should be absolutely feasible.
So in the spring of 2010, of course, we had limited experience, not only in real estate, but in private markets in general. And we decided that we need to get some really good external advisors in. We recruited at that time Mark Burton and Andrew Strang into our real estate advisory board. And Mark Burton has had 5 decades experience in real estate investing, and also led up the real estate effort of a major sovereign wealth fund. And we have Mark with us from London today. Good morning, Mark. Yeah, we need to get adjusted the sound there, but my first question to you would be a very simple one. When you joined our advisory board in June 2010, what was your expectations? This was an unknown entity without experience on this area at all.
You're absolutely right, Ingvar, and can you hear me now?
Yeah.
Okay, great. It was unknown, and so I think I had sort of 3 feelings: one of excitement, one of intrigue, and one of nervousness. And the excitement was that, as you say, I had a relatively similar role, senior role at another sovereign wealth fund, and we saw most of the large deals, real estate deals around the world. And I find that tremendously exciting. And I thought that with the Norwegian Sovereign Wealth Fund, the potential funds that you had and the potential allocation that you had indicated, you would be likely to see some of these big deals as well. And so that I found tremendously exciting, and that has been borne fruit. You have seen most of the big deals that go on around the world, I would suspect. And then there was a bit of intrigue because, as you say, you were an unknown entity, and don't take this the wrong way, but Norway did not have a sort of big reputation for being big investors in real estate around the world. And so how were you going to organize this vast fund? How were you going to staff it? How were you going to structure it? What kind of investments were you going to go for? I mean, I found that just absolutely intriguing as to how it would all work out.
So how did it play out? When you look at it 10 years later, how did it actually play out? Was it about as you expected?
So I think probably I was expecting a wider geographical investment base. I was probably expecting you to be investing in more cities than you do. But having said all of that, the strategy that you have undertaken has worked. You have less costs, you have less disturbance and hassle factor from doing things that you don't really want to do or know about. And so, yeah, I would come back and say, although it was not what I was expecting, it's a strategy that has worked, and the returns that you have got indicate that. And I think even more so, as we come out of this dreadful period that we're in at the moment, people will see that your portfolio has actually survived that as well as anything, with the quality of tenant covenants that you have gone for and the hope for stability of income that will be proven as we come out of the coronavirus issues.
You actually know the portfolio really well. You've seen all the transactions coming through a decade here. And for those who haven't seen the portfolio in that kind of detail that you had, how would you describe the assets? What's kind of the general take on it?
So you have probably differed from some of the other sovereign wealth funds in that your prime reason for investing, I suspect, is downside risk protection. And that has been done at the expense of significant upside potential. And all of the investments, when we discuss them at REAB, the downside risk has been absolutely paramount. And you also have got a portfolio which you wanted, whereby the income component is more important than the capital appreciation component, because, as you said in your opening remarks, that's one of the reasons why you went into this. So you have a portfolio, some people would probably call it rather dry. It is very core, and that's what you wanted. And as I said earlier, I think that when we come out of this coronavirus period, you will see that the income stability of your portfolio will have held up really extraordinarily well. Your probably, if you were looking at a portfolio of other sovereign wealth funds, your retail component is probably not as strong. And again, as things have turned out, that is not a bad thing to have. So your portfolio in San Francisco is probably, to me, one of the more interesting ones, because I suspect that you are heavier into San Francisco than most other institutions. And it's been proven to be a very good investment. You got in at the right time. There are some really cracking buildings there. And I think that's great. Like Carsten, I think your Prologis investment was unique is the wrong word, but it was a bold investment at the time to take such a large proportion into logistics. Logistics, as we all know, has proven to be one of the better sectors in real estate over the last year or so. And so, yes, you don't have too many smaller buildings, and the buildings that you do have I think will survive the current crisis and do really well going forward. And I think the other point I would make, and I remember actually, Ingvar, right from day one, you commenting on the fact that if you had a large number of buildings in one city, it was well possible that down the road you could monetize them into a form of a REIT or whatever, if that is what you wanted to do. And with any illiquid investment, you've always got to have some form of exit strategy in extremis. And I think that your portfolio has that potential exit strategy, if it were ever needed, a lot better than some of the others.
Yeah, it's right. We were thinking a lot about the exit strategy quite simply because it was a potential move to go the whole way to 10 or even 20% in real estate, and then you have to think about it. If you want to get out, how do you do that in an elegant fashion? When you sit and look at a portfolio, I think it's basically described as a 50-50 US-Europe. We're trying to build Asia. It's coming, concentrated on very few cities in each of these two markets. And then this thing about logistics being a full quarter of the portfolio, that's kind of unusual. Would you agree?
Yes, I would agree. I think more and more over the last 2 to 3 years, people have seen the benefits of logistics. So I think more and more logistics is becoming a larger part of the portfolio. But when we first started, logistics was sort of the poor third of the family. You know, nobody really enjoyed logistics. The rents were kind of like, you know, £1, £2 a square foot, and yields were right out at 7.5%, 8%. Today, logistic yields in certain places are sub 4%. I mean, that's a terrific compression of cap rates and therefore increase in value. And I think that in Asia, it is difficult to get into Asia in the way in which you wanted to do it. You want to do it with joint venture partners, which I don't disagree with at all, and particularly in Japan, you've probably only got 2 or 3 joint venture partners that you could do business with. And to do what you've done in the Otomachi deal is good, and hopefully will pave the way for more investments in Japan. Because at the end of the day, Japan is a pretty mature real estate market. And it's one I'm hoping that you will find more investments in.
So I think we kind of refined the strategy a bit. We've actually gone to even fewer cities than what we expected. Early on, we talked about maybe 10 or 15, and we're down to 8 now. And it has to be some cities who have a global leading edge somehow. But it's also built on the premise that we should be able to be not as good as locals, but at least trying to, because the real estate is, of course, a game for the locals. And when you look at it today, we have, of course, spread out these teams on different locations. But you think we have that kind of an insight, that feeling for the different local markets?
Yes. So again, you've differed from others, other sovereign wealth funds, in that you have gone for satellite offices to provide that local expertise and experience. Many others have gone for third-party asset managers, but you are going to lose a little bit of control if you do have that. So yes, I think you do have the local expertise and experience, and it's increasingly important to maintain that and to implement it where you feel it is necessary. Because real estate is a local game. The deals come from being in that city. The deals come from people knowing the people in that city. You have to go out and use a bit of shoe leather and go round and see things quickly. It's a local game.
So when we looked at this first deal we did in Regent Street, of course, it wasn't first of all thought about as retail, because in one sense we said that in retail we really want those streets who can participate in branding something more than actually the footfall to the store itself. And later, of course, that was combined with the global logistics to distribute it, and happily we stayed out of most retail in the form of shopping centers, etc. Now this is a challenged sector, but it seems like even an office is getting a bit challenged these days.
Absolutely right. And my view, for what it's worth, is that you should take this period where not a lot is happening in the market, very few investments are being made, to do, there's a wonderful army expression called time spent in reconnaissance is seldom wasted. And I think the people that are going to, the landlords, the institutions that are going to come out of this best are those that really understand and have talked with their tenants and understand how much space they're going to need going forward, be it office or be it retail. And I think that you, I'm sure, are doing that, and retail will change. And I suspect that the more outdoors retail you can have, the more attractive that is going to be. And I suspect that there will be some of your buildings that don't actually require the full floor plate. And what is it you're going to do with that? There are any number of options available to you, but I think that it is pretty important that you understand now where those potential vacancies, either in offices or in retail, are, and how you are going to fill them.
So finally, Mark, you're looking into the future. What is the best advice you would give us going forward on the bigger strategic choices?
Well, there's another great old saying which says, if it ain't broke, don't fix it. I halfway believe that, but I always think you can tweak it. And so going forward, what you now have, in my judgment, is the building blocks. You've served your apprenticeship. You've got the building blocks. You've got a team. You still have quite a lot of money. And you now are able to utilize that and perhaps do slightly different things. So I think that as we come out of this crisis, there will be some forced sellers. They will be forced sellers because probably there is a little bit of vacancy in the building. And I think you could take a little bit more leasing risk. I think you could possibly take a bit of leverage. I don't think interest rates are going to rise for any time soon, and I think a sort of 15 to 20% leverage on deals going forward would benefit you in terms of returns and not increase the risk that you are running. And I think, yes, you have cut back on some of the cities. I think you should, because there is going to come a stage where actually you are full up in certain cities. So I think you should look at potential other cities to invest in.
So Mark, thank you very much for being with us today, and thank you for the 10 years that you and Andrew has participated in our investment and contributed to us in a great extent. So have a joyful summer, and we'll see you later.
Well, thank you. It's been great fun. Thank you.
Okay, Karsten. Real Estate Advisory Board. We've had some good benefit from having some senior investors here, but basically we have built, to a large extent, a very young team, all from scratch.
Yes, I think Mark talked about it as well, the importance of local teams and how we have built the organization and how we've set the whole thing up. Very much in the same spirit as the rest of NBIM, actually, because one of the things that attracted me 10 years ago was the fact that this was an investment organization and that it was focused on knowledge, specialization, and pure investment knowledge. And so for us, this idea of building the local teams where there weren't any and really get that specific knowledge about the submarkets, the tenant dynamics, the capital flows in everywhere we would invest was very important. And it was important to, at the same time, ensure the consistency and avoid strategy drift when you have people all over the place. But I think that the teams we did build in London, New York, Paris, and Tokyo are they're great teams that keep us close to the markets we invest in. They allow us to engage with partners, be in the deal flow, and get access to transactions.
So when you think about, this is in line with the whole fund's kind of credo. We like to have specialization, we like to have deep knowledge, we have to analyze things all the way. But it must be a balancing act here, though, because the very concentrated strategy we have will, on the other side, probably narrow the opportunity set for you.
Yeah, I mean, obviously, if you say we're only going to invest in these cities and we're not going to invest in all the others, that kind of by definition restricts us. Having said that, though, I think there's some great benefits in the concentration because our presence and the specialization and the knowledge, it allows us to, as I said, be in the deal flow and probably get access to more transactions in the markets we're in. And also, very importantly, invest with a lot of confidence. And I think that, on balance, outweighs the downside of just being in a few markets.
Yeah, I think when we started out and looked at it, the whole organization is built for kind of a characteristic of an investment decision. We think about investment decision, then we build organization. And if you think about real estate, it is not as liquid as other asset classes. It takes time to carry through an investment. Pricing is not that visible. It's not a stock exchange where you can get the pricing all the time. It means that it's a good thing to be long term, of course. It means that you need to build a good governance structure. But it also means that there will be some challenges in terms of verifying the transactions. And to a large extent, that means that you have to build an organization where the investment decisions are taken by a joint effort with a whole set of people. And in one sense, it's an organization that is more team-oriented and more oriented for collaboration rather than delegation. So how have you been kind of thinking about that?
Yeah, so it's true. When we started, there were, 3 people the summer of 2010. And so it was a huge effort in building this. And we had to actually hire everybody and either hire or develop them from who we were. And hiring is one thing. It's always difficult to hire the young, hungry, and eager now colleagues of ours. But you also have to, of course, build the culture, as you said, and you have to fit it together. And I think this idea of balancing the local teams with the centralized decision making has been a delicate one. I think we've had an extraordinary team, and we've been lucky to get a lot of talented young professionals in at an early age, and I think they have pretty much all of them risen to the occasion. They've stepped up, they've been given a lot of responsibility, and they've delivered on that. And I think that created a culture to allow for that balance between the local teams with a lot of responsibility, but still with somewhat of a centralized decision making. And that I'm sure has created a lot of frustration in some of the local teams. The fact that they engage with the market, they pursue transactions, they find the opportunities, they engage with partners, and yet the decisions are taken in a different place, in a centralized place. The benefit of that has been I guess, probably more discipline, less strategy drift, but it's also created a lot of accountability in the system because it's not in single individuals who have taken decisions far from the head office, and so that has created, I think, an interesting dynamic.
But I think that is quite often the case for any global business and global investments in particular, that you like to not end up with a set of regional offices who do their own stuff, and you don't want to have a centralized decision making who doesn't get a feel of the local market. So how you kind of build that balance is part of the trick here. It's
tricky. It's very tricky, and I think one of the things is that we've had relatively few, as you call it, satellite offices, international offices. There's been a handful, but we haven't been all over the place. And so I think there's been a balance where we've had these, the 8 cities we've focused on, and a handful of international offices, talented people given that room. But it's also been easier from a centralized position to actually stay in touch with the markets and the teams because of the scale. Because we've had the irony of a gigantic portfolio, or rather a fund, large scale, but still a relatively small team in few locations.
But as Mark mentioned, there's several layers of risk management here. First, we kind of go for those markets who probably are the most transparent, where we can actually see the pricing, where there may be a bidding process, where we know where the competition is, where we know where we can take out things. And in addition to that, we have these local teams that kind of reinforces even more knowledge about the same thing, even in transparent markets. And in the third layer, we have from the start put in this partnership, and we're trying to find the best local partners. So it's kind of 3 layers of making sure we kind of at the right place and at the right price here.
Yeah, you're right. We started out with partners. You know, we mentioned Regent Street in the past. I think now more than 2/3 of our investments are with partners. It's been a very important part of our strategy and of our last 10 years. It has provided the access to new markets, access to deals, instant credibility, you know, and it has allowed us to deploy capital very efficiently. The key, though, to getting this to work, in my mind, has been the 2 forms of alignment, if you will. It's been the economic alignment, so finding partners that can invest significant money alongside us, because it is different if you have you know, whether it's a 30-70 or 50-50 joint venture, it's very different than a 90-10 or a 95-5. It gets a different feel. So the economic alignment, and where, importantly, where both sides pretty much make all their money from the equity investment, and it's not like one of the sides have significant fees coming out of it that changes the dynamic. So that alignment is important. And the other one is a pure, let's call it philosophical alignment, where we look at investments in the same way. We have the same investment horizon. We look at the world in a similar way when it comes to buying, selling, and upgrading assets.
And I think in addition, a fund like ours, you know, you really want to have a reputable, high-quality partners to start with. And we did the first investment. We actually went forward all the way, to put it that way, with a Crown estate. And we have with us today a person who got on the plane to Oslo in June 2010.
Yes, Paul Clark, who has been is the outgoing CIO at the Crown Estate. He's been a very important person in this relationship, and therefore also for us over this last decade. Paul, you know, you came to us, as Ingve said, in June 2010, and you know, at the time we had no investments in real estate. We had just gotten the mandate. There was a small team. You know, what on earth were you thinking?
Well, good morning, Carsten, and hello, everyone. Thinking back 10 years, I suppose the place to start is, why did we get on the plane in the first place? And as you know, Carsten, the Crown Estate is a capital-constrained business. We can't borrow, and we don't have material sources of internally generated fresh equity. And as we were developing and maturing our own asset management model, it was apparent to us that we were going to need significant sources of capital to do everything that we wanted to do. And one of the ways we decided to deal with that was to find long-term partners in a small number of strategic joint ventures to work alongside us. And the criteria we established included the sort of commercial criteria that you would expect in terms of looking for partners who are financially substantial, long-term time horizons, and long-term structural security themselves. They're going to be around for quite a while. But alongside that, and you've just alluded to this in what you said, Carsten, we were looking for really close cultural alignment, high standards of corporate governance, transparency and decision making, right alongside the conversation that you've just had with Ingve. And that's what we were hoping to find in our partner for Regent Street. And once we're actually able to find the front door of the Norges Bank, which in itself is not the easiest thing to do, we found an organisation that had very similar values to ourselves.
Right, and we ended up as partner a little bit later that year, and it's been 10 years. So how has that worked from your side? I mean, as you heard from us, we're clearly very happy with that first investment.
Overall, it's been everything we could have hoped for and more. The teams have worked together tremendously well and continue to do so in what are currently challenging circumstances. And it's probably worthwhile reflecting at this point on the simplicity of the arrangement that we have. There is no vehicle as such, there's just a layered leasehold interest. You have your 150-year leasehold interest, Karsten, and alongside that we have our management agreement and our annual business plans, but it's a very simple model. And so over the last 10 years, it's really been down to two smallish teams where there's been an awful lot of continuity over that period. Some changes, but an awful lot of people have been around for the whole or a lot of that time. And the teams have worked together in a very uncluttered and collegiate way. And if you drill down a little bit further and you think about it in a number of sort of subsets, financially, I think we would both feel that we've done well out of the last 10 years on Regent Street. Values have trebled. Now we've put some money in to that, so it's not that's not all pure upside. Rental income is up about 2.5 times over that period. So it feels, from a financial perspective, it's been very successful. Operationally, we, between us, have spent £640 million on about 20 deals, ranging from tiny ones of £1 million or so, right up to some quite substantial acquisitions, and they've been both head leases and the acquisition of freeholds to extend our position on Regent Street, and that's enabled us to build up the opportunities for the future, and they will be the development sites in years to come, and right up to the present, where the teams have had some tough decisions to make in terms of handling the cash flow issues that come out of the current crisis. And lastly, I would say, from a corporate perspective for the Crown Estate over the last 10 years, it's been great for us as well, because we went from a business with a fixed pool of assets to one that was growing and developing what it was doing, and that was tremendous for our ability to recruit and retain high quality staff, and it injected a dynamism right through our organisation, because we were now looking after not only our own interests but those of our partners.
Right. No, absolutely, and it's interesting because, as you point out, we've had a great partnership. Of course, we have had discussions along the way on all these, acquisitions or developments and everything that's been done. But I can't really recall, maybe this is just bad memory, of any really significant disagreements we've had. But there's been quite a lot that has changed on Regent Street over the last decade. It's, at the end of the day, a business, and you can define it in different ways: an outdoor shopping center, a part of a city, whatever. Talk to us a little bit about the priorities that have taken place on Regent Street over the past decade.
Well, when the partnership began, Regent Street was already through its tartan and travel agent phase. The team, for nearly a decade, had already established it as a major global retail centre, and that gave us something to work with. What we tried to do from there on in was to build on that, particularly in terms of creating a destination from more of a mixed-use perspective. And one of the biggest elements of that has been the extent to which we've been able to improve the office stock, to take advantage of the development sites that were built up over the years. Between us, we've built something like just short of 500,000 square feet of new space, and in the office sector, we've taken rents above £100 a square foot for Regent Street for the first time. And it was important to us that Regent Street was seen as a destination in the fullest extent, whether that's retail, which was a great base to build on, but also offices and leisure. And that's been a great success, I think, of our partnership over the last few years, that we've been able to take advantage of the opportunities which, to be fair, the market has presented us with.
And the world is changing, of course, and as I said, the Regent Street has changed a lot. For those of us that remember walking down Regent Street, as I said, 12, 15 years ago, and to walking down today, it's just two completely different worlds. And a lot has changed, as you mentioned, retail and other, and we talked about whether office is changing as well. You know, how do we make sure that Regent Street stays relevant going forward, or any similar investment like that?
Well, of course, that's principally going to be an issue for the team that are going to take this forward. At a generic level, my personal opinion is that all owners of real estate, whatever size they are going to have to develop a much more granular relationship with not just their traditional customers, but with everyone who uses their real estate, whether that's to work, to live, to shop, to eat, whatever it is. There's going to have to be a much more sophisticated and granular relationship that's going to be built on a more sophisticated use of data. We will all have to develop digital platforms that will enable this sort of connectivity to take place at that granular level. And I think it's also quite possible that we'll all be looking for partners at that operational level that will help us access the sort of technology that's going to make it possible for us to behave in the way that we want to, because we've got used to talking about how challenging retail has become in recent years and how demographic, technological, societal changes are affecting the way that subsector is viewed and used. But we also know that the same is increasingly true for offices, for example, and what the events of this year have really done to a large extent is to intensify and accelerate things that were happening gradually anyway. And we will find that whilst I believe offices will still be an important part of real estate portfolios, they will get used differently, and it'll be the most agile and sophisticated owners who are able to work with their customers in order to ensure that offices can operate efficiently and safely.
Excellent. Well, just finishing up, Paul, you know, we usually like to think of ourselves as long-term investors, and then you guys come along and you represent an organization with 350 years of investment history. Do you have any parting advice for us?
Well, I think this is an interesting time to begin giving anyone any advice about anything, to be honest with you. I believe that organisations that genuinely have long-term time horizons enjoy a great privilege, and they need to use that privilege wisely. And I agree with what Mark said earlier in respect of the next few months or years will throw up opportunities for long-term, well-capitalised real estate investors. And the thing, I think everyone who's got a long-term perspective needs to remember that whatever you do, you should hook it back to your long-term strategy. You've had a very clear one, Carsten. You've spoken about it. You've stuck to it admirably. So I think you always need to think about every decision you make, and does that play into the long-term strategic goals that you have. Don't just do something because it seems like a good idea at the time and you end up in a sector that perhaps you're not so expert in, or a geography that you don't know as much about. Stick to your long-term strategy and find the opportunities that the next few months or year or two throw up that enable you to move towards it.
Good. Well, Paul, thank you very much for that. Thank you for an exciting decade. I wish you all the best in your future endeavors beyond Crown Estate. So, you know, clearly we appreciate this, and thank you.
Thank you, Carsten. It's been a great pleasure working with you all for the last decade.
Thank you. So we clearly were very lucky with starting out, as you said, with Regent Street, and our experience with Crown Estate has been a very, very good one, and in many ways it formed many of the other relationships we've had after we made this investment 10 years ago.
I think in general, I mean, there's no partnerships we left. We have been able to be working quite well with all the partners we had. Of course, Crown is the longest running one. But we now have a decade of investing in real estate, and this has been in all respects positive one for the fund. We have followed the strategy that we set out pretty much all the time. We have executed with patience and discipline and in scale. But it must have been something, Carsten, that you kind of, or we should regret that we did or didn't do.
Yes, of course. Nobody is perfect. A lot has changed over the last 10 years. So there are always things you would have done differently. We talked about some of the markets that we looked at and then exited or didn't even start investing in. We made some investments where we eventually sold. So maybe we should have spent, maybe we did spend more time than necessary in certain markets. Maybe we should have been even more focused. Maybe we should have gotten to the 8 cities earlier than we did. In hindsight, also, I think we did put on the brakes for retail investments. Maybe we should have done that a bit earlier. Of course, when you make investments, hindsight is a great thing because you see all the great deals we should have done and maybe some of the ones we should have sold at a different point in time. But big picture, though, I am fairly happy with what we have done. We put together a strategy and we stuck to it, and that strategy included staying invested through cycles. So, I mean, bottom line, I'm just very proud of the team and the organization and what they've stood for and delivered in this past decade.
So before we round off, we will have time for a few questions from people listening in.
We do have quite a lot of questions, so we'll try to cover some of these. The first one, from your point of view, how has the market changed during these 10 years?
How has it changed? Well, I think we've seen markets changed all the time. So one things that have been mentioned is the change in focus on sectors. 10 years ago or 15 years ago, it was very much office, retail, maybe residential, maybe hotels that people focused on. Retail was always one of the most exciting sectors. That has certainly changed over the last decade. And logistics, which was seen as more of a less interesting investment to have on the side, has become a major asset class, and there's been an institutionalization, a professionalization at all levels throughout that. I think we've also seen changes in where capital come from, the role of REITs, private investors, private equity funds, etc. That keeps developing, and at different points in time, you will have different sources of capital that invest the most, and that in itself will drive the focus in the market.
And another one, Nordic real estate has been booming over the last decade. Why haven't you made any investments in your neighboring countries?
Well, I would say that's also a fairly that plays straight into the strategy, and Yngve asked me earlier. Well, a narrow strategy does not mean you will miss out on a lot of great opportunities, and the answer is yes, we will miss out on a lot. But there's something about the scale and the focus here, and booming cities are everywhere, and it's very different if you have tens of billions of dollars to invest or you have one or two. So for us, my guess is we could have made good money in other cities. But I don't know how much we could have reasonably deployed, what share of our portfolio, and at what cost of resources, establishing teams, etc.
Do you see any major challenges in 2020 and for the next years?
Yngve, maybe you want to... You want to take that one?
Well, I think clearly we're not lacking challenges in the state of the world these days, so we just have to be, as one of our guests said, careful to give advice or strong statements about the future. And I think we're just generally sticking to our strategy. We're going through cycles. This may be more than a cycle, what we're seeing now. Real estate will change. It will change in fundamental ways. But we are still, we think, quite pleased with the portfolio that we have, the assets that we have gathered, and they should hopefully weather this kind of a situation better than many other types of assets.
Yeah, I think I'd just add, I think that's right. And I think we do have a portfolio that was focused on being able to sit through cycles. And we don't know what the future will bring. As I think Mark was mentioning as well, I think we have a lot of downside protection in our portfolio, but at the end of the day, who knows what the future will bring.
And then I think this will be the final question, as we are running out of time. What do you see as the biggest lessons learned during these past 10 years?
Oh, lessons learned. There's a long list here. I think certainly in terms of building the organization and forming this investment strategy, the most important thing of all, I think, has been to understand the framework and the constraints and opportunities that your capital source provide. So for us, the fact that we've had a large allocation has been very important. The fact that we've been inside the central bank has been very important. And I find that very often when you talk to other real estate investors, they kind of assume that we all start from the same place, so that a good investment is the same for everybody. But I think it's very clear that a good investment for one investor may not be a good investor for another. I think it's very clear that the world is constantly changing. It's very easy to try and put everything in order and predict the future. Predicting the future is very difficult. We have seen constantly that even though you have the normal business cycles that we invest through, and where we can try and at least understand them, if not predicting them fully, the world keeps throwing us curveballs. There are these, call it external events, that are very hard to predict. So, the idea of protecting the downside and letting the upside come, I think has been a valuable lesson.
So I think to sum it up then, I think most important point probably is that we have invested for the long term in high quality buildings in a few leading global cities, sticking to a very concentrated strategy, using it more to diversify the fund than diversify the asset class itself. We have had a return on close to 8% after cost, beating the funding benchmark with more than 3%. We had a capital appreciation of 100 billion, a return of 10 billion a year from what we invested in. I think kind of personally, I think I speak for both of us, Carsten, it's been an exciting time. It's been a privilege to lead the fund into a new asset class. And I think both of us are extremely proud of what a young, enthusiastic, energetic, and capable real estate team has been able to achieve. Absolutely. So with those final words, we do invest in real estate to safeguard the financial wealth of future generations. And going forward, that's what we continue to do. So thank you very much for your attention. And we're rounding off here, and I hope you all have a good summer.